The world has learned nothing from the mistakes of the 2007 and 8 financial crisis, and I feel we're poised to repeat those same mistakes. Before I carry on, I just want to say this is not all doom and gloom. This is rather going to be a discussion of the what if scenario. But in order to create that what if scenario, I think a bit of background is necessary. In 07-08, a series of events that are well documented and worth researching occurred that effectively led to a global liquidity crisis. Essentially, there was a collapse in lending, there was a collapse in willingness of banks to spend and lend to each other and to other companies and to businesses. This was because so many banks were on the verge of bankruptcy because they had made bad investments. These bad investments had been made into the housing sector, the US housing sector, which at the time was giving away a lot of loans to help people get onto the mortgage ladder. But those loans they were giving, well, they weren't really vetting the people they were lending to. So a lot of these people weren't really able to repay those loans. In any case, when those loans came due, a lot of these mortgage companies wound up going under. A lot of the shares that were associated to these mortgage companies wound up losing value, and a lot of the investments by banks on top of these shares, well, they started losing value, and a lot of the banks started losing money very quickly. It was a contagion, a virus that spread. Again, the details of this have been well covered, and I recommend watching a movie like The Big Short if you want to get a handle on this. But that was my sub 2-minute introduction to the topic. Anyway, as I said, there was a global financial crisis, a lending crisis, a liquidity crisis. Banks were out of money. Banks didn't have any money to give. Because there was no money to give, there was no money to support the creation or the maintenance of existing businesses. A lot of our world's economy, a lot of our world's jobs, a lot of our world's companies were all at systemic risk from this event. And so what happened was the world's governments banded together and they came up with a plan. And in the Western governments particularly, there was a broadly overarching plan and agreement that we're going to do the following. We're going to speak to our central banks. And the central bank in the UK, the Central European Bank, the Federal Reserve, which is the central bank of the US. And these guys all collectively agreed we're going to push our interest rates down. And that way, banks will have a reason to effectively lend. Okay, they don't have as much money, but if you can borrow money and the interest rate is low, then paying off the loan's going to be cheaper. So there's your stimulus to take out loans. At the same time, the central banks assisted or facilitated the buying up of a number of these failed banks by their local governments. And the other big thing that happened was something called quantitative easing. Now, what this was a program through which central banks would print lots of new money for their respective nations. So the UK printed loads and loads of new pounds. The European Central Bank printed loads of new euros, the US printed loads of dollars, and all of that new money would be used to buy up bonds and other debt instruments. So predominantly, all the new US dollars, a lot of them were used to buy up US government bonds, but they also used to buy US corporate bonds and various other debt instruments. And what this basically did was create a lot of buy-side pressure on stocks and bonds. And a lot of this new money was given to a lot of these banks. And what they did with it was use a good chunk of it to buy up stocks and shares in various stock markets to also buy up bonds, they essentially reinvested a lot of this new money that had been printed, and this helped stimulate flow of money, flow of the economy, flow of the exchange and trading of services of goods. These were all the secondary effects of this. Quantitative easing actually encouraged the lending and the spending that is essential to keep our economy afloat. But there was a side effect. The vast majority of average citizens in the lower and middle income brackets, the vast majority of them don't own shares. They don't own stocks directly. Most of them have pension funds. That's their main exposure. And that's not something that pays out immediately. That's something that pays out at the end of a 30, 40-year working life period. So a lot of the lower and middle income bracket people, which just generally make up the majority of citizens in any given nation, if you don't believe me, just look at any wealth inequality chart. The majority of these citizens, who are the majority by number for most nations, they really didn't benefit from the subsequent rally in global stock markets that followed the 07-08 crash. The subsequent rally that had effectively been funded by their own governments and their own central banks. They didn't see any financial benefit to this. If anything, they suffered because interest rates were near zero, which meant their return on savings, and most lower and middle income people live off savings and credit. Because their interest rates were near zero, yeah, they had access to credit, but their savings weren't generating them any real revenues. And if anything, the rate and pace of inflation was far exceeding the rate at which their savings would grow in value. As such, the majority of people in the lower and middle income bracket from 2007 and 8 to now have experienced considerable wealth decline. They've experienced a considerable loss of spending power. Don't believe me? Go look at a US inflation calculator between 2007 to now. The USD has lost 25% of its value. It's a fact I've stated many times before, but the spending power of your average citizen, the majority of citizens in fact, in the US and the UK and in most parts of Europe, has gone down significantly in the last 13 years. And what you've seen is a contraction of what was formerly known as the middle class in the UK to effectively merge with the working class. Our concepts of low and middle income have been gradually merging over time. This has been, by the way, on a backdrop in the UK of what's called austerity, whereby the government supplied a double punishment. They would cut back on spending for social services, public services, so things like healthcare, policing, schooling, infrastructure, roads, all of these things would basically suffer and went into various states of disrepair and dysfunction as a result of chronic underfunding, which has created its own social crisis. Now, the sad thing is that all of this was potentially avoidable, and not for the reasons you think. So here's the funny thing. If most citizens of lower and middle income backgrounds, who make up the majority of populations for most countries, if most of them had dedicated stocks and investment portfolios by now, they would actually be fine. If they had that basic financial education, if they had that understanding that savings was not a good idea, that putting whatever savings you had or a good chunk of it into index funds would have been the right way to go. If governments had just emphasized that, then the majority of citizens would be better off now than they are today. But they aren't. In 07 and 08, no one in the media or the news was telling me overtly in general publications, there wasn't an overwhelming message of having a savings account is garbage. And in reality, if you look at a 10-year time frame, based on what we're doing, you're going to be losing money. No one told me that I'm going to lose 25% of my wealth by holding it in a savings account, just sitting there doing nothing. Because financial education in this country, in the UK, and I believe globally across the world, for your average citizen is poor. Financial education is the domain of the elite. And it's that focus on financial education that allows the elite to stay elite. But it's that lack of financial education that's gotten us to where we are now, a great big puddling mass of confusion and disrepair and disorientation. The world is in a fugue, it's in a panic again, because we've had to print off several $1 trillion just to keep everything afloat, because we've had to shut down all of our businesses, because we have a great reckoning incoming once things start opening up again post COVID-19, which is now becoming COVID 2021. But again, that's a detour. That's not my point. All of this could have been avoided. But it's not only that. It's not only the financial education. It's the fact that they have excess money to begin with. And that's the thing. I, in 07-08, was in a fortunate position to have money to potentially stick in an index tracker. But a lot of people didn't. A lot of people didn't have much in the way of savings to begin with anyway. So, actually, a good chunk of the lower and middle income bracket, they were living on the breadline to begin with. They didn't have money in savings to put into stocks. And thus, the vast majority of populations around the globe in nations that adopted 0% interest rates and quantitative easing, the vast majority of citizens in those nations, they actually weren't the beneficiaries of this effective wealth generation in the stock market. They weren't the beneficiaries of anything. If anything, their spending power fell because the value of their savings, the value of their currency fell, because their wages weren't rising against the inflation rate appropriately. They weren't matching the inflation rate. If anything, if you look and think carefully, real world wages in the UK have effectively fallen against the rate of inflation. Real world spending power, certainly in the UK, has fallen versus stagnation of wages in the public sector versus the compound effect of inflation on a currency, and certainly versus the wealth concentration that has occurred within a small group of individuals who are fortunate enough and educated enough to be dealing in the domains of stocks and shares and investing in other more complex financial instruments. As such, we have created an entirely new kind of liquidity crisis in our global economy, one by which less than 1% of our population globally own well over 50% of global wealth. It's effectively saying half of the world's wealth has to be split between 99% of the world's people. And when you think of it that way, it kind of makes sense that governments may struggle to fund basic infrastructure, basic services. It kind of makes sense that people are going to struggle to survive in that sort of environment. It kind of makes sense that businesses, small businesses, may struggle to take off, because the vast majority of wealth isn't actually being distributed. It isn't really flowing. It's just getting locked up and concentrated into a pot that no one's really touching. And the worst thing about this is it's kind of self-perpetuating. If you look at the structure of modern capitalism, it is designed to encourage wealth concentration. The big problem here is that the majority of shareholders in most private corporations are private individuals who do not work for the company. The best interest of shareholders is to see the price of their shares go up over time by any means necessary, moral or amoral. It doesn't really matter at the end of the day, as long as the share prices go up in a sustainable manner and create wealth for the shareholders. The shareholders don't have to work for the company. They're under no obligation to the employees of the company. They can sell their shares or trade them at any time they please. And that's the problem with capitalism. Whilst the generation of capital and the trading of these shares is supposed to stimulate investment into new industries, is supposed to stimulate the growth of companies, it doesn't necessarily mean that the growth of those companies has to be efficient. It doesn't mean the growth of the companies has to have a focus on the well-being of the constituents of its corporations. And this is the thing. Corporations are a body. Corporeal, literally means body. And when we're not paying attention to the health of that body for a long or extended period of time, how can we possibly expect that body to stay healthy if we're not focused on the well-being of the corpus of the corporation which is the fundamental building block of the company, powered, represented by shares? If the shares that are supposed to represent this corporation, if they don't really represent the constituent parts, and if they're not focused on the well-being, if that's not their priority, then a corporation, no matter how highly it's valued, fundamentally cannot stay healthy forever. And ironically, this is where the solution I'm proposing, if it had been implemented in 2009, would have meant that even in the setting of prolonged austerity, i.e. even in the setting of massive cuts to public services and spending, even in the setting of 0% interest rates, even in the setting of quantitative easing, would have meant that our citizens, the vast majority of citizens in any country adopting all of these measures, would have come out financially much better, which would have meant spending power would have been much better, which would have meant fundamentally our economy would have been much healthier. If this solution I'm about to propose had been implemented, we wouldn't have the degree of wealth inequality we have now. The wealth inequality gap wouldn't have widened over the last 13 years. It would have narrowed. And it's simply this. If you look at a corporation, look at its share structure, and let's look at the law and the constitution governing our countries, and let's just say, fine, if you want to run a private corporation, that is great. And if you want to have shares in your private corporation, also great. But at any given time, half of those shares must be held by employees of that company. So if your company has 100 shares and 50 employees, then each employee gets one share. That's 50 shares. The other 50 could be traded privately. Say that company then decided to issue 100 new shares, so there'd be 200 shares in total. Okay, well, of the 100 new shares issued, 50 would go to the employees, and then 50 would be going out to the private market for non-employees to hold. So then the employees would have 2 shares each, which would total 100 shares, versus 100 shares being traded privately or held by private shareholders. If an employee left a company, well, then they could take their 2 shares in this scenario and they would hold on to them, but then the company would have to issue out new employee shares, which would then be distributed equally amongst all the remaining employees in that company. If the company hired a new employee, they would have to issue new employee and new private shares to be redistributed amongst each group accordingly. And these shares, both held by private individuals and by employees of the company, would effectively confer equal voting rights powers and equal proportions of ownership in that company. And this would have to be constitutionally enforced by law. So any company that traded from outside into that nation, or even within the nation, they would have to abide by this policy. So yes, you have foreign multinationals which may be subject to different laws if they have a HQ that's outside of yours. But what I'm saying is, to avoid the obvious loophole, they would have to set up a limited company within this nation which abides by this constitutional rule in order to operate. But why am I saying this? Because if you took a corporation and you made it so that by law, by constitutional law, all private corporations had to ensure 50% of their shares were held by their employees, then immediately your corporate board has to keep the best overall interests of employees at heart in any decision making it undertakes. Imagine you're the chairman or the chief executive officer and you're about to give yourself a 300% pay rise whilst your employees are getting a 20% pay cut. Suddenly, in this scenario, because 50% of shares are held by the employees, they can vote you off the board if you go ahead and do that. They can lobby you. They can put real pressure on you. They can punish you for bad behavior that is disproportionately negative to them. If you're the board and you're proposing we need to sack 10% of our workforce in order to bump profits, well, then your employees are now going to look and say, is that because we are simply not as efficient as we could be, or are you just being greedy? And then decisions and pressure can be applied accordingly. It's the idea of effectively building in a form of unionization into a corporation by default, rather than having a union exist as a separate entity that is in conflict with the board. It is about harmonizing the concept of unionization with the corporate board by effectively ensuring the employees of that company have shares. They are a union by default. It actually renders the traditional concepts of unionization unnecessary. You won't need independent unions. They're built into the corporate structure. And this is the problem that I see with a lot of responses to modern capitalism. The unions are too weak. The unions are failing. The unions aren't doing their job properly. Well, that's because there's no real incentive to. There's no real incentive for corporate boards to really listen to or harmonize with unions unless the unions are effectively adopting a nuclear policy of strikes. And even that ability is diminished when you consider the fact that we operate with a global workforce. And yeah, this is why there might be some overarching problems with this proposed solution of mine. We have a global workforce. Companies could still operate elsewhere. But I still think it's better than what we have now. And I still think it's workable. And I think people will find ways to game this, and I think people will look at ways to game this idea if it was implemented. Because ultimately, self-interest is first interest. And this is the thing people need to understand. Because self-interest is first interest, if your incentive structure isn't aligned to match the representation of the people who are involved in that structure, then the incentive structure will simply reflect the best interests and the first interests of whoever that incentive structure favours. The current incentive structure in modern capitalism favours private shareholders, but we could restructure the very nature of corporations to ensure that the incentives of employees have at least 50% favourability. We could structure it in such a way that employees will always have a significant say in a corporate boardroom, that a corporate boardroom will always have to consider the interests of its employees as part of its incentive structure, as part of its self-interest. The board's self-interest is no longer predominantly about private shareholders, it's now about shareholders of whom 50% work for the company. And if this solution had been implemented, then anyone who ever worked for a private company, they'd probably hold shares in that company. And since the vast majority of shares were on the up and up, those employees would have been better off today than had they been 13 years ago. And the spending power for many, many employees would have increased proportionately if those companies had performed well. And if those companies had performed well and their stock price grew organically, you'd have a stock market which is much more closely tied to the fundamentals of business efficiency than to games of speculative trading, which, as Reddit is currently demonstrating, is heavily manipulated. And what about the public sector? They don't operate on a shares-based system. Maybe they should. Maybe governments need to adopt the capitalist model that I'm proposing, i.e. pseudo-privatize or fully privatize the public service sector and implement the share structure that I'm proposing, i.e. 50% of shares held by employees and 50% traded in the private sector. Or maybe governments just need to realize that workers in the public sector, as part of their overall remuneration in the form of guaranteed shares in an automatically rebalancing index tracker, e.g. the FTSE 100 or the Nasdaq. And this way you could ensure that the public sector remains independent of the private sector, whilst enabling public sector employees to have relatively low risk long-term exposure to the stocks and share markets. My point is that we need to have a societal shift towards encouraging our citizens to have at least some form of passive involvement in the stock market, because under current economic conditions, what we have is not sustainable for the vast majority of people.